on with the Boeings that are coming in? Well, sir, they're way behind, and they are. They're way behind. They were way behind.
Term perspective, getting focused on executing on these development programs is critical for our company. And then selling internationally, it's creating U.S. jobs, long-term, high-value U.S. jobs.
Imagine the U.S. government slaps a 200% tariff on Boeing's own planes just because they were partially built across the border. Now imagine China, one of its biggest clients, walks away. Jets worth billions sit grounded, unwanted. In a single move, Boeing, an American icon, faces a full-blown geopolitical crisis. At the center, a bold decision to shift manufacturing to Mexico. Was it business logic or corporate rebellion? This isn't just a trade war. It's a high-stakes standoff between a company fighting for survival and a government demanding loyalty. And what happens next could reshape global capitalism itself. In early 2025, Boeing made a decision that would set off a political firestorm. It announced plans to shift part of its aircraft assembly operations to Mexico, a move driven by cost-saving, efficiency, and global competitiveness. But what might have been just another logistical realignment in the global supply chain became an explosive symbol in America's increasingly nationalist economy. The backlash was immediate. The White House responded with an ultimatum. Any Boeing aircraft not fully assembled in the United States would face a crushing 200% import tariff if sold domestically. For Boeing, whose largest customer base is U.S. airlines and the U.S. government itself, this was not just a threat, it was an existential blow. Tensions erupted when a private call between President Trump and Boeing CEO Kelly Ortberg was leaked. Though the exact words weren't made public, insiders described it as blunt, uncompromising, and intensely personal. The message from the Oval Office was clear: build here or pay the price. Rather than back down, Ortberg took a bold and highly unusual step. He went public. In a televised statement and interviews with major networks, Ortberg defended the company's move, arguing that Boeing wasn't turning its back on the U.S. It was ensuring its survival in a hyper-competitive global market. "We're not leaving America," he said. "We're securing our future." It wasn't just rhetoric. Boeing's strategy reflected a hard reality. Production costs were rising. Global competitors, especially Airbus and China's COMAC, were gaining ground. Boeing had already endured reputational damage from high-profile safety issues and was desperate to streamline operations and restore stability. Still, the optics were brutal. An American aerospace giant, long held as a symbol of U.S. industrial excellence, openly defying a protectionist White House. Suddenly, Boeing wasn't just an aircraft manufacturer, it was the face of corporate resistance. Investors were rattled. Markets wavered. Analysts warned that the proposed tariffs could wipe out tens of billions in revenue and trigger retaliatory moves from global trade partners. But Ortberg doubled down, positioning Boeing not as an outlier, but as a leader redefining what it means to be American in a globalized economy. With the threat of tariffs looming, the confrontation escalated beyond headlines into high-stakes geopolitics. China, Boeing's second-largest market, swiftly retaliated. The Chinese government ordered domestic airlines to halt all future Boeing purchases and freeze ongoing deliveries. More than 70 jets, some already manufactured, were suddenly in limbo. These weren't just numbers on a spreadsheet. They were multi-billion-dollar assets grounded by political gridlock. As the story broke, Boeing's share price dipped, wiping billions from its market capitalization in hours. Trade analysts warned that the move would reverberate through hundreds of suppliers across the U.S., from Wichita, Kansas, to Everett, Washington. These communities depended on Boeing contracts for thousands of jobs, and now those contracts were at risk. Inside Boeing's leadership circle, the mood was defiant but tense. The company began quietly exploring alternative markets, shifting inventory toward emerging economies like India, Vietnam, and Indonesia. These regions, with growing middle classes and expanding aviation networks, became Boeing's Plan B. It was a gamble. These new customers didn't offer the scale of China or the certainty of U.S. military orders. But they provided one thing Boeing desperately needed: breathing room. Ortberg, meanwhile, refused to be cornered. He used every public appearance to reinforce Boeing's commitment to innovation, safety, and global scale. "This isn't about moving jobs out," he told CNBC. "It's about securing our position as the world's aerospace leader." Privately, Boeing ramped up lobbying efforts, warning lawmakers that the tariffs could jeopardize not just commercial jet sales, but also defense contracts critical to national security. The Pentagon depended on Boeing for fighters, tankers, and other military platforms, began asking quiet questions about contingency plans. The White House, however, was unmoved. Nationalism was the message, and corporate flexibility was seen as betrayal. For Boeing, survival now meant threading the needle between global market forces and domestic political expectations, an almost impossible balancing act. As the tariff standoff intensified, its impact began cascading through Boeing's supply network. Aerospace is not a one-company operation. It's an intricate web of suppliers, each dependent on stable production timelines and consistent global demand. Small and mid-sized manufacturers across the U.S., companies that produce landing gear, avionics, titanium components, and specialty materials, saw contracts paused or scaled back. Many had already been stretched thin from previous slowdowns during the 737 MAX crisis. Now, the tariff-induced uncertainty was forcing them to freeze hiring, furlough staff, or, in some cases, shut down lines entirely. And it wasn't just components. Logistics companies managing aircraft parts across borders suddenly found themselves entangled in a maze of regulatory red tape. Delays at ports, new customs inspections, and pricing volatility threw inventory schedules into chaos. A single aircraft delay could cost millions, and now dozens were delayed. At the same time, Boeing's strategic rivals were seizing the moment. Airbus accelerated production in its U.S. plant in Mobile, Alabama, capitalizing on the chaos. China's COMAC positioned itself as a neutral alternative, promising predictable pricing and low political exposure. For carriers operating in Southeast Asia and Africa, these promises were appealing. Back in Washington, the political narrative had shifted. What began as a story of one company's relocation became a broader debate about the role of multinational corporations in national economies. Lawmakers on both sides of the aisle clashed publicly, some accusing Boeing of betrayal, others warning that economic retaliation would only accelerate deindustrialization. Meanwhile, Ortberg doubled down on Boeing's strategy. He issued a statement defending global production flexibility, arguing that maintaining competitiveness required adapting to a world where cost, proximity, and talent availability couldn't be confined to one country. The markets reacted with cautious optimism. Boeing's stock, while volatile, began showing signs of stabilization. Still, internally, Boeing faced a complex truth. It couldn't win this battle through PR alone. To survive this confrontation and emerge stronger, the company would need to deliver results, at scale, on time, and with undeniable precision. In the midst of mounting tension, Boeing executed a quiet but decisive pivot. Rather than fight for shrinking ground in China and absorb domestic political pressure, the company expanded its outreach into new, less politically volatile territories. India became a focal point. With one of the fastest-growing aviation sectors and government-backed ambitions to become an aerospace hub, Boeing found willing partners. Deals were announced with Indian carriers, and joint manufacturing initiatives were explored with local firms. Vietnam and Indonesia followed suit, offering access to labor, logistical advantages, and growing demand for fuel-efficient mid-range aircraft. Ortberg and his executive team knew these markets wouldn't replace China in terms of volume, but they offered diversity and insulation. No single country could again hold Boeing's future hostage. To support this shift, Boeing reshuffled its internal structure, forming a global resilience task force charged with navigating supply chain disruptions and forecasting geopolitical risks. It was a rare move for a company of its size, treating policy and diplomacy with the same seriousness as engineering and finance. Meanwhile, the strategy began to pay off. Deliveries to new markets climbed steadily. In Q1 2025, Boeing delivered 130 aircraft, up from just 83 in the same quarter the previous year. Revenue jumped 18% to nearly $20 billion. The company still operated at a loss, but its free cash flow surpassed analyst forecasts, and Ortberg confidently projected a return to profitability by year's end. Still, Boeing's rebound didn't erase the pain. Aircraft meant for China remained stranded. Warehouses across the U.S. held idle jets valued at billions. Boeing's cash flow was improving, but its inventory was swollen. And while Southeast Asia brought optimism, those buyers negotiated hard. Margins were thin, domestically the pressure persisted, congressional hearings grilled Boeing over its outsourcing, and defense analysts began asking if national security could be compromised by overseas production. Boeing responded by emphasizing that military projects like Air Force One and fighter jets would remain 100% U.S. built, but the scrutiny refused to fade. In effect, Boeing was performing a high-stakes balancing act, building the future while defending the past. Beyond politics and market shifts, Boeing faced an even greater challenge: restoring trust. The company was still recovering from years of reputational damage following the 737 MAX disasters and the more recent 2024 mid-air incident involving a door panel failure. These weren't just technical issues, they had become moral ones. Questions about Boeing's culture, its priorities, and its integrity. Airlines needed assurance. Pilots demanded better oversight. Regulators, still haunted by past failures, tightened the leash. Every delivery now carried an extra layer of scrutiny. Boeing responded with increased transparency, overhauled safety protocols, and stronger internal auditing. 𝐸𝐸 appointed a new chief safety officer with sweeping authority, independent of operations. At the same time, Boeing was racing to stay ahead of technological shifts. Sustainability had become a key metric in the aerospace sector, and Boeing's next-generation aircraft programs needed to deliver not just fuel efficiency, but tangible progress toward net zero goals. Rival Airbus had already launched partnerships focused on hydrogen propulsion and electric flight systems. Boeing, lagging in these areas, was under pressure to prove its innovation muscle hadn't atrophied. To regain leadership, Boeing announced new investments in sustainable aviation fuel research and unveiled prototypes of a blended wing aircraft, a radical design aimed at lowering emissions and increasing lift-to-drag efficiency. The company also partnered with MIT and NASA on aerodynamics projects and hinted at potential acquisitions in green propulsion startups. 𝐸𝐸's message was clear: Boeing would not just survive this moment, it would use it as a catalyst for reinvention. But reinvention came with risk. European clients like Ryanair warned they might shift orders to Airbus or COMAC if tariffs pushed up prices. U.S. defense contractors quietly explored alternatives for satellite and cargo platform components. And global carriers made it known: any repeat of past failures could destroy what little goodwill remained. Still, 𝐸𝐸 pressed forward on three fronts. First, transparency. Boeing began releasing monthly performance reports and launched a dashboard that tracked delivery times, component delays, and safety checks in near real time. It wasn't just a PR move, it was a bet on accountability. Second, diversification. The company opened regional headquarters in Singapore and Sao Paulo. It expanded training programs for engineers and pilots in emerging markets, embedding itself deeper into the ecosystems of future customers. And third, credibility. 𝐸𝐸 personally met with airline CEOs, regulators, and labor unions, laying out Boeing's roadmap and asking for trust, not just contracts. By mid-2025, the results were mixed but trending upward. Production lines had stabilized, supplier confidence had improved, and Boeing's standing in Washington, while still fraught, was less combative. The crisis had not ended, but the storm was no longer consuming the company, it was reshaping it. If this video helped you understand the high-stakes clash between Boeing and Washington and what it means for global industry, hit that like button so others can find it too. And if you want more deep dives into the stories shaping our economy, subscribe now. We break down complex events in clear, engaging ways every single week. Thanks for watching.